only 0.0037 seconds to place an order. Our system availability rate was as high as 99.96%, even in 2020, when the market was highly volatile, offering clients an extremely smooth trading experience. We also strive for perfection in product development and innovation. Futu clients can trade various financial products, including stocks, ETFs, warrants, options, and futures. We independently developed a gray market trading system for Hong Kong new shares 1 day prior to their listing. We offer a variety of order types to meet the diversified needs of investors with different investment strategies or portfolios. We provide clients with a unified purchasing power that is based on account assets and can be used cross-market. Investors can mortgage assets to obtain financing and buy stocks in another market. This function eliminates cross-market currency exchange costs as well as time costs, enabling investors to seize every investment opportunity. In the Hong Kong and U.S. stock markets, we provide securities lending services so that clients can implement diversified investment strategies. Our intelligent risk control platform monitors risks in real time and protects client assets. Taking into account various risk sources, Futu integrates market data, all-around assets conditions, and algorithm capabilities to offer monitoring, stress testing, and advanced alert functions. The risk status of each client account is calculated on a real-time basis so that risk factors are minimized. Our wealth management brand, Money Plus, is dedicated to reducing decision-making threshold and increasing capital efficiency. We have built a complete set of online trading procedures, PI online certification included. Money Plus provides convenient wealth management services by seamlessly integrating stock trading and fund investment. Clients can subscribe to over 100 fund products from more than 50 leading fund houses across the globe. Offering functions such as automatic redemption, subscription booking, fund comparison, automatic investment plan, and fund portfolio, we are committed to improving the investment experience of our client and creating a one-stop wealth management platform. Futu Bull offers access to advanced quotes of U.S., Hong Kong, and China A-share markets. We offer diversified in-depth quotes for investors in different regions. Futu now supports 22 drawing tools for charts and 62 technical indicators through which investors can mark, analyze, and customize stock charts, grasp price trends, and gain insight into buy-sell points. Futu clients have access in real-time information that is both practical and insightful, including stock transaction size distribution, capital flow trends, top 10 net buy-sell brokers, analyst ratings and target price forecasts, etc. You can also use functions such as AI Monitor and Real-Time Stock Screener to assist you in making smarter investment decisions. We also offer a 7x24 news service. Clients can have instant access to global financial news, economic event calendar, IPO news, and industry trends, grasping first-hand market dynamics in a timely and in-depth manner. We have established an investor-focused community that connects users, companies, media, securities analysts, and opinion leaders. More than 600 companies have joined our community, and there are nearly 1,000 highly active news agencies, institutions, and companies. Users can share and discuss market views in the community at any time, watch live streams of company events, and attend investment courses. You can also share your trading profit loss with fellow traders to share joy or seek support. Here, trading is no longer alone. You may also share your trades, write posts, make comments, and interact with other investors in the community or in chat rooms. It is also possible to find key opinion leaders, analysts, fund managers, and executives here. Why not talk to them and listen to different people sharing their investment knowledge and insights? Futu I&E is our corporate service brand. Our ESOP service is trusted by nearly 300 Hong Kong and U.S. listed and unicorn companies. We help companies manage employee share incentive plans. Futu ESOP system supports the granting, management, and exercise of multiple incentive instruments. Companies can sign various types of online agreements with employees via the system and realize efficient data management throughout the procedure. Employees can track their own incentive status, exercise options, and trade online through app in a fast and stable manner. We also provide one-stop services for tax planning and withholding, overseas trust service, and foreign exchange registration, tailor-made for corporate clients' specific incentive programs. Win-win results are thus achieved for both employees and companies. As an enabler of new economy companies, Futu has also built a bridge of communication between the companies and investors. Companies can rely on Futu for IPO underwriting when they go public, while Futu clients can subscribe to IPOs online and participate in gray market trading. Companies may also manage investor relations by opening a Futu page and thus accurately reach out to a community of tens of millions of investors. Futu has always stayed true to its founding vision: make investing easier and not alone. Futu has emerged as a leading fintech company with global influence and keeps leaping forward. Sparing no efforts in refining its products, technology, and business operation, Futu relentlessly pursues its strategy of internationalization and remains committed to providing global clients with premier services. This is Futu. Futu. Make investing easier and not alone. Through Futu Bull and Mumu, Futu aims to build a fully digitized online brokerage and wealth management platform. Futu is dedicated to transforming the investing experience and becoming an influential global financial services platform. Relying on our proprietary technology platform, we provide more than 15 million users with a wide range of services such as trading, margin financing, securities lending, wealth management,
Slides, yeah.
Yeah, we'll do that. Okay.
Hello, everyone. Hi, welcome. Welcome once again to another series, another round of shows that we've put together with the team for you, where we actually interview the experts to be the bridge to guide you, to help you make better investment decisions. Once again, you're with me, Olivia Higgins, and we've got our first show for today, Bull or Bear 2023 Defensive Playbook. And kicking it off, we're going to go into Q4 investment strategies with our expert from BNY Mellon Investment Management. And today it's all about covering a macro and markets update going into the new year. Now, I've got a lot of community questions, especially in our offline event. I'm pretty sure I saw some of you there. Thank you for joining us. But for today's online series, it's really all about going into spotting opportunities. And so that's why we're here really to help you and guide you towards that self-directed investment journey. But remember to use this as an educational tool, not as advice at all. So use this as just a way to complement your current strategies. And of course, with our expert from today, we're going to learn about new perspectives and also where you should look at, right? Because these are the questions that are on the minds of people towards the current market situation. And so that's why we're here, and we take it very seriously, this financial literacy tool, and to help you overall in your decision-making process. So without further ado, thank you once again for joining us. I'm going to introduce our first expert for the series of shows. We've got the head of Asia Macro and Investment Strategy from BNY Mellon Investment Management. Say hi to the head of Asia Macro Investment Strategy, Aninda Mitra. Hi, Aninda.
Hello. Thank you for having me.
Thank you so much for joining us on the show. Now, you're the first speaker of a Q4 investment strategy series, and we're very, very glad to have you today. Now, could you just tell the audience a little bit about yourself and also what can they expect to learn from today?
Sure. A bit about myself. On the next few slides, we have a little intro on myself and the firm that I represent.
Sure. Tell us about it.
Sure. So I work as the head of Asia macro and investment strategy for BNY Mellon at the group level. As you can see from the next slide, we cater to a lot of boutiques, a lot of investors across a spectrum of boutiques, which touch virtually every major asset class. Next slide, please. And we have a long history going back to the days of Alexander Hamilton, and we count amongst our clients a client base as diverse as ranging from family offices and retail to financial advisors, sovereign wealth institutions, governments, and so on. We on the investment management side, on the next slide, what you will see is that we are the fifth largest asset manager in the US, US-based asset manager with 1.8 trillion in AUM across our boutiques. We are also the world's largest custodian with 42 trillion in assets under custody and 5.5 trillion in tri-party collateral. So without any further ado, that's a brief overview of ourselves. I'm very glad to be at this meeting to talk to your investors and clients. And I hope you'll give our products a look at the end of this seminar. So if there's two things I want you to take away from this thing today, is that number one, we are facing the biggest inflation challenge we have in a generation. This is the kind of inflation rates we haven't seen since the 1970s, and it's a serious challenge. It's tempting to see past a peak and look for opportunities and risk and so on, but the key thing is that this is a very challenging backdrop in which central banks will be responding aggressively to and persistently so, and it creates a very complicated environment for investment, and that's my second point. So there's no easy way out, which is why the title of my presentation is "We're Still Very Defensively Positioned." It's a defensive playbook which we are recommending. Now, what we typically do, we have a quarterly exercise where we put out what we call a vantage point. In this, what we do is try to visualize the world through a probabilistic framework. And our most current views from late September are that there's a 60% chance of a global recession going into next year. Europe's probably already slipping into one. The recovery in China looks a lot shakier than I think a lot of people have been expecting just a few weeks or months ago. And the US will continue tightening. They have a serious inflation problem on their hands, and albeit it may not be at a 75 basis point pace, but they'll still keep tightening. So what that means is that the scope for a soft landing, this is something the markets keep hoping for, that somehow, miraculously, inflation will come off without a big jump in unemployment and risk assets will rally. To that, we assign a 30% probability. And the risk of something breaks. This is where something cracks. And we have begun seeing cracks. We've seen cracks in the crypto space. We've seen many frontier emerging markets fall through the cracks. Sri Lankas and all that come to mind. Could there be worse? It's hard to predict ahead of time where the next epicenter of a new financial crisis might be. But for now, we are assigning that a 10% probability. So that's how we're framing the global picture. But let me jump into the details of how we see specific aspects of growth and inflation playing out. What you'll see on the next slide.
Sure. Well, Aninda, I'm just going to pause you right there. So thank you for putting down that contextual analysis. Now, for the audience out there, because, coming back to the ones who just joined, you're joining us for a global market outlook and defensive playbook. So Aninda just highlighted just the context right now and also the position that BNY Mellon has taken for this current time. So Aninda, could you just highlight, I know you've got a presentation for us, but maybe you could just go into detail about why it's taken so long for a recession to materialize in Europe and the US.
So there's a lot of tailwinds in the US from the stimulus, for sure. In one of my slides, we have the enormous growth in money supply, which reflects the degree of stimulus that went into the system and so on. And in Europe, there is still a reopening impulse. We've been anticipating a recession. The PMIs look awful. Real wage growth has turned negative. But despite all of that, what we are seeing is that there continues to be a reopening impulse from late summer and so on. There's still internal travel within Europe. So those are the factors which have kept these economies from going into a recession. But if you look at the charts on your screen, we are looking at the US possibly going into a recession next year. And in Europe, we expect to see a more steeper drop in output in our base case, with a recovery, not really materializing until the second half of next year. In China, we see a more of a flattish growth profile for another quarter or two, but there's a significant downside risk, that light shaded area, which you can see below our base case scenarios for China, and that highlights the possibility of a banking crisis. Now, nobody's expecting it, nor do we. That's not our baseline, but the risk of that is certainly out there, and it starts to pull down the overall base case for China. On the next slide, what you have is the inflation outlook. And again, in the US, you see the market expectations, the yellow dots and the little red crosses are for a more benign inflation outlook in the not too distant future, whereas our outlook is a bit more cautious. We think inflation is already looking quite persistent. And in Europe, we do see inflation coming off faster, in fact, because the growth slowdown, is looking like it'll be steeper in the case of Europe. Next slide. So this is what I was referring to. We are looking at a generational challenge in inflation. Both charts basically show that you're seeing more inflation out of reserve currency issuing countries than you have in a very long time. And even the inflation surprises. This is the amount of inflation you get versus what the market's been expecting, or the survey of economists has been expecting, is much more adverse in developed countries than it is in emerging markets. Next slide. Now, the causes of inflation are a bit different in the US versus Europe. In the US, it's clearly more demand driven. You can see this in the core rates of inflation, which are looking very persistent. Now, it does look like the headline rate is beginning to keel over, but if you look at the core rates in a bit more carefully, that's, putzing along. It's not showing any imminent signs of a massive decline just yet. And in Europe, what you see is a very large supply side shock, given its proximity to Russia and its dependence on natural gas supplies from Russia. The steep increases of energy prices has sent producer prices to stratospherically high levels, and that's what's pulling up consumer prices as well. Next slide. And this is what I was getting at earlier. Why has it taken so long for these economies to slip into a recession? On the left side, what you see is the big jump in money supply growth in the US. And this is the amount of excess savings that came into the banking system and caused M2 to jump much higher than it ever has in more than a decade. And on the right chart, what you see is a massive terms of trade shock. This is the terms of trade, by the way, to clarify it, is simply the ratio of your export prices divided by your import prices. And with energy prices as high as they are, you've seen a big downturn in European and Japanese terms of trade. It's causing a big hole in their balance of payments in the current account as well, which is what has weakened the yen and the euro, amongst other things. But that's the difference in the shocks you're seeing between US and Europe. Next slide. So, again, there's some signs of resilience. What you see here is that the ISM, which is the equivalent of the PMI indicators for the US, are beginning to keel over. They're just at 50 or slightly above that level, but retail sales are still putzing around. That's on the right chart. Those are still holding up reasonably well. But again, insofar as that continues to sustain, we're saying that the Fed will continue hiking, perhaps not at a 75 basis point pace, but it'll still keep hiking. Next slide. And a bit more detail on inflation. I mean, there's been a bit of excitement in the market that U.S. inflation may in fact be turning over. What I've done on the chart on the left is to look at a momentum measure, which is a 3-month average versus the previous 3 months, and then you annualize that growth rate, and you see the headline rate has come off, but the core rates have not. And again, there's also a theory that upstream prices are beginning to come off because of producer prices being slipping into deflation in China, supply chain improvements, and so on. And yes, there is something to be said for upstream prices coming off, but it's the core inflation rate which matters. So don't be surprised if in the months ahead you start to see core inflation in the US actually stay stickier and higher than the headline rate, and the Fed will have to react to that. Next slide. So again, some inflation survey expectations still show that the Michigan survey expects inflation in the year ahead to be very high, 4 or 5%, and wage growth is still running at north of 5%. So these are completely inconsistent with inflation stability or reaching, or for the Fed to reach its 2% inflation mandate. So we still have more tightness to come through the pipeline as far as Fed policy goes. Next slide. So in contrast, the market, if you look at the break-even rate of inflation, this is the gap between the nominal bond yield and the TIPS yields, the real bond yield, which shows you the market's expectation of inflation. And that is for it to come down to 2.5-ish levels across the curve in the next few months and years. But if you look at a stress test of what kind of monthly rates of inflation you need to run to get inflation down to towards 2% in the year ahead, and that what you see from that fan chart on the right is you need about 0.2% to get inflation close to 2% by the end of 2023, and below 3% or around 3% if you run 0.3% month on month. So we are just getting to those things. We're not even there yet, to be honest. On the next slide, what you'll see is, again, durable inflation on the left chart has come off. It's lower than its long-term average, which is about around 0.11% or so on a month-on-month basis. But services inflation, the yellow bars on the left chart, are still much higher. And what's keeping it high are sticky items like healthcare and shelter. And these two alone account for about 27-28% of the total CPI basket. So those are still, they're not running at 0.2%, which is where you need to be to get inflation down somewhere close to the Fed's target. They're still running way above the long-term averages. Next slide. So what all this results in is in a trade-off. The chart on the left shows you the relationship between unemployment on your x-axis and job vacancies on your y-axis. And the current rate of unemployment is about 3.5%, with job vacancies running at 6.5%. What that tells you is that there's almost 2 jobs for every single person that's unemployed. That means wage bargaining power is very strong. And that's also pushing up wages as much as it is in a slide which I just showed you a few moments ago, which is running currently at 5% or higher. So the policy trade-off from all this is that if you look at the unemployment rate on the right chart plotted against inflation, the Phillips curve, this is what policy wonks call it, used to be very flat. So you would have to get fairly large shifts in unemployment to move the needle on inflation just a little bit. Now, with such high inflation, a soft landing would basically imply that inflation miraculously comes off. In other words, there's a big stepwise drop in inflation without a hike without an increase in unemployment, or there needs to be a bigger, more labor market weakness. That's a sacrifice ratio, if you will, which the Fed will need to tolerate to break the wage price spiral. So we haven't solved this trade-off yet. So, which is why one needs to be cautious about hoping or expecting to cash that turnaround, because 1 or 2 inflation prints have surprised to the downside. Next slide. So what that leaves us with is a policy pricing of the Fed funds rate, which is still pretty steep. This chart is actually from 18th of this month. It's a little bit dated, but nevertheless, it's not too different from where the latest Fed funds futures curve stands at. The market expects to see the Fed funds rate at the December meeting, for the Fed funds dot plots to shift a little bit higher to about 5% or so. And that's what the red line is telling you on the left chart. But then if you look at the right chart, even though policy pricing has shifted higher, there's still an expectation for it to come down quite a bit by the middle of next year. So that's quite inconsistent with a soft landing scenario where inflation comes off but output still holds up. So this almost tells me that there's concern about a recession in the medium term, and that's exactly the scenario we've been crafting, expecting a recession by the second quarter or third quarter of next year in the US. Next chart. So if anything, in the year ahead, we do expect to see some convergence of policy rates, given where the futures curve is pricing things at. The ECB has been slower in hiking, but has sped things up a little bit at the last two meetings, but it is expected to catch up to Fed policy pricing in the year ahead. So that's probably, amongst other things, what is contributing to a weakness in the dollar. And what you'll see on the next slide is precisely that the dollar's begun coming off on the right chart. It rose very steeply, but then it's begun coming off quite sharply. And also the equity upturn in China since the beginning of this month has been very steep, and it highlights some optimism that the China reopening will offset some of the exceptionalism of the dollar and allow risk assets to rally. But if anything, most recent events from the last week or so suggest that China could be heading towards a more messier reopening than what some of these charts may be suggesting so far. Next chart. So there's still bad news to come. The chart on the right basically shows you that the earnings outlook for the US could be headed lower. This is a plot of the forward earnings against CEO expectations, CEO confidence rather. And the chart on the left basically shows you that if you were the ratio of cyclicals over defensives plotted against the ISM manufacturing index is very strongly correlated. So you'd be better off with defensive rather than cyclicals, considering that the US economy, going by the ISM numbers, is still slowing down. So we don't expect a bottoming out just yet. So which is why, from a risk basis, we prefer defensive over cyclicals, is what I'm getting at. Next slide. So again, the bond market for sure is pricing in a recession. The chart on the right shows you 3s, 10s, and 2s, 10s part of the yield curve, and those are both below zero. They've inverted, and the 3s, 10s in particular is probably even a more sensitive measure of inflation pricing out there. And on the chart on the left, what I've tried to show you is real yields plotted on the right axis and inverted is positive for the first time in a very long time. And that correlates pretty strongly with the S&P's forward PE ratio. And insofar as you expect that real yields will stay elevated, it's hard to argue for a rally in PE stocks, in high PE stocks especially, given that you're still using a larger discounting factor. And as I showed you in the slide earlier, the earnings momentum is probably still going to come off as the ISM numbers continue weakening. Next slide. And if anybody was hoping for a big offset from China, I think it's on the cards, but it's probably going to be a bit more messier, a bit more volatile than what a lot of people thought would be the case. So the chart on the left basically shows you traffic congestion across the big 4 or 5 top tier cities in China. And the red line shows you where mobility or traffic congestion is this year versus the norm in 2020, 2021. And we are well below what the norm would suggest mobility should be at in China. I think they've probably gotten worse in the last week or two, given the renewed lockdowns after cases have soared. The chart on the right basically shows you the credit impulse. There's been a pickup in the impulse, but it's hardly impressive if you compare it with the previous two peaks, where the degree of the stimulus coming through from Chinese credit spigots was much bigger. And that also correlates pretty well with the Li Keqiang index, which is a broad coincident measure of activity, aggregating freight indicators and electricity output and so on. So those are still they have recovered a little bit, but they're still at a fairly weak level on a going forward basis. Next chart. So what all this means is that the CNY has recovered in the last 2 weeks. It's in the last few sessions alone, it's come under renewed pressure. But on a trade-weighted basis, if you see the chart on the right, that's begun keeling over. So the recovery, what little recovery you saw in the CNY was less than what you saw in the Japanese yen or the Korean won, and therefore on a trade-weighted basis, the CNY has begun weakening. Now, if the dollar strengthens from here because of renewed concern about China and so on and so forth, that could be pretty bad news for Asian assets, Asia FX more in particular, and for risk assets more broadly. Next slide. So we get to the end here. So if you had a traditional 80-20 portfolio, we don't actually expect a recovery until late 2023, if at all. One needs to be more defensively positioned. We have been suggesting neutral fixed income, overweight cash, overweight dollar cash in particular, and underweight equities for a while. We could be seeing some opportunities in fixed income and credit more broadly if we do expect a rally in risk-free yields on a going forward basis. But the big picture is that if you look at risk in its totality, a traditional 80-20 portfolio would not be working very well for several more months. Next slide. And this is also borne out by just a year-to-date assessment of equity market returns by sector and by factor. It's, again, the more defensive sectors, your utilities and energy and consumer staples and healthcare, which have done better than riskier high P stocks, more growth, kind of growth-oriented securities out there. I think I'm reaching the end of this. That's all I had, unless there's any other slides after this. If you could check, please. Is that the last slide? Yeah. Okay. So this slide basically shows you that bond yields have begun keeling over. They're quite a bit higher than what the market pricing of inflation is. So you do have some positive real yields, which you haven't had in a very long time. So make use of that. The income in fixed income is back. So we're not full-blooded overweight on the bonds just yet. We still think that there's a bit more policy hiking to come, but I think we're getting to the peak in shifts in yields. So if anything, we probably see an overweight in fixed income coming before an overweight in equities, if I had to take a more forward-looking view of things. I think I'll end it there. I believe that's the last slide. Yes, it is.
Well, thank you so much, Aninda, for sharing your insights. And of course, we've already got a lot of questions coming in from the audience. And as usual, it's always fun to pick out the best questions from the live audience. And thank you for being a part of the discussion to the audience out there. Now, Aninda, let's just have a quick chat about the current topic. So for those of you who just joined, Defensive Playbook, we're going into macro and markets update, going into the new year. Now, Aninda, my first question to you is, rate hikes might be slowing, but how high will the Fed rates go?
So the market's priced in just about 5%. We think that there will be further hikes, not at a 75 basis point clip, as I was highlighting earlier, but we could easily see at least 250 basis point hikes. And what I think the Fed will ultimately want to see is a positive policy rate adjusted for inflation. So if inflation is still at, if core inflation in particular, if it's still at 5% plus, we could easily see Fed funds at slightly above that 5% level. So the market's not expecting a 5.5% terminal rate just yet. It did go to that level a few weeks ago, but then it pulled back after a good inflation print. But I wouldn't be surprised to see a Fed funds rate go above 5% and stay there for a while.
Mm-hmm. Well, thanks for sharing that. Now, everyone is talking about inflation, of course, but what is, the medium-term outlook for inflation? And I think just to define it a little further, which time horizon is ideal to look at in the current market situation?
So next year is going to be a year of two halves, at least. The first half, you'll still be struggling with inflation, even though headline inflation may come off, and that'll result in some optimism. Keep in mind, the Fed also looks at the core rate of inflation, the PCE core in particular.
Right.
And that could remain sticky for a long time. And the risk is that if they start to signal some comfort about the headline rate coming off nicely towards the Fed's target rate and so on, they could inject more risk taking into the system and in fact cause wages to rise even further. And that's something they will want to avoid. It's a bitten once, twice shy kind of a story. So they thought it was transitory to begin with. They were wrong. They have begun moving very fast. They are getting to a restrictive level, not just a neutral level, but restrictive level of policy. But I suspect they'll want to keep it there until they start to see core inflation. That's the key thing, core, not headline, come off a little bit more. So that'll take some time. So even though headline may come off in the first half, core will take longer. It'll probably take that improvement will slip into the second half, which is why I'm saying it's probably going to be a year of two halves.
Right. Very good distinction there. And I think also there's a lot of talk out there about the analysis. So sometimes, the audience is confused who they should listen to and what definition they should take. So thank you for outlining that. And thank you again to the audience for your questions. We'll answer it towards the end. All right. So Aninda, could you just tell me a little bit more about China? So I think that one is another hot topic trend. So how will China's reopening impact the global markets? And let's really focus on the macro outlook of 2023.
So our base case has been that reopening in China was never going to be easy. And I think that point was just underscored by the developments of this weekend. I don't think anybody was expecting that. But, when you see President Xi walk around without a mask and deal with world leaders, which I think was a very good development, by the way. I think it resulted in a thaw in the relationship between the US and China. Good development, no doubt. But also when you're watching the World Cup play out and large parts of the world are not in a state of perpetual lockdown,
right?
It gets more and more frustrating, and that popular frustration builds up, and that catalyst may have been the apartment, tragic incident at the apartment in Urumqi. So, but it underscores how difficult it'll be to tread a fine balancing act between winding up zero COVID, but not doing so in a fashion that sends cases soaring when you still have an elderly cohort of the population which is not fully vaccinated or adequately vaccinated. So it'll be a stop and go situation for a while. 2 steps forward, 1 step back has been our base case, and this weekend's events, I think, underscore that point. So we're looking at more normalcy possibly in the second quarter, more towards the middle of next year. And that accords with a pickup in GDP growth to maybe around 4% or so, maybe a bit higher, if they can manage things pretty well from here on. But that's a good thing. I think the market wants to price that in. We saw a big run up in Chinese equities since the beginning of this month. They gave back some of those gains last week. They lost 3% or so, if I go by the MSCI China at least. But the brunt of the adjustment will likely be taken by the FX. So we're still looking at FX underperformance. So if you have exposure to China, I suggest, we're suggesting being FX hedged and awaiting. What's attractive about Chinese assets right now is that the equities look very cheap. Even on a standardized basis, they're more than one standard deviation cheaper than the norm. So To cut to the chase, we still like the equities. We are neutral equities, even though on a global scale we are underweight. We're suggesting underweight equities, but in anticipation of the reopening in China, and given how cheap equities are, we've been suggesting being neutral, even though we are underweight globally on equities.
Right.
But we are more worried about the FX, given that there's not much scope to cut interest rates, and what little cuts the PBOC may deliver may actually spark further FX weakness.
Good points there. Now, if you really go out to the global outlook, of course, we'll talk about a little bit about geopolitics. Now, you've got the aftermath of the NPC in China, and then you've got the midterms in the US. So how will politics affect the macro outlook for 2023?
So, could you be more specific? What kind are you, domestic politics or geopolitics? What are you referring to?
For the purpose of today's live show, let's focus on geopolitics as a realm to look out for, and at least in terms of affecting decisions that people make. What are your insights on that?
So I think we just crossed two important hurdles. One is the NPC meetings, which resulted in the political transition we just saw coming out of China. And the second one was the midterm elections in the US. Now, excuse me, in the run-up to these two events, both sides had taken on a very hawkish tone against each other, which I think resulted in a bit more nervousness in global markets. Now, it has never been our base case that the odds of an outright conflict are very high. But with these two important events behind us, and given the warmth in the tone, I think creates a slightly better backdrop to at least begin or reopen a channel of dialogue between the US on the one hand and China on the other. But will it result in solving some of the underlying structural issues on technology and so on? I'm not very optimistic on that front. But insofar as you have a better understanding of each other's red lines and how to negotiate and manage some of these issues, is always a good start, rather than not talking at all. So don't expect a massive resolution of underlying conflicts, but don't expect the relationship to go off the rails either.
Right. Well, thank you for highlighting those points, because we've already got a lot of questions related to this political realm, but also, they are still trying to figure out what they should do next, going into the next few months. And of course, a lot of the questions are centered around short-term goals for next year. So let's cover those topics later on during the live Q&A. But before we end this fireside chat, now, Aninda, could you just give me a key takeaway before we close off and go into the live Q&A?
Sure. My big takeaway would be, guys, inflation is not dead just yet. It's still a big risk, and the policy reaction to it is not something I'd immediately get comfortable with. So that, in a nutshell, would be my key takeaway for investors. Yeah.
Perfect. Okay, so we'll be right back with you shortly. But for the audience out there, thank you for listening to the insights, and we hope that you've been taking your notes, because I'm about to show you as well how to apply what you learned from today. But before we go into the demo, let's start with our first giveaway for today. Now, I know you guys love this, but here is how the quiz works, all right? So for those of you who answer the questions correctly, we're going to be giving away about up to 3 prizes today. You'll be awarded these points, and also you'll be able to answer, if you get it right, you'll be able to get contact from our teammates to really redeem the points, but also be a part of the engagement as always. So I know you guys love the quiz, but of course, if you were listening, you will probably get it right. So this is how it works, and with that, let's start with quiz number 1. So I'm going to count to 3, and then I'll read out the questions. The fastest fingers first, and those who get it right will walk away with our giveaway. All right, are you ready? Type in yes in the chat box. The question is, in 3, 2, 1. What is the average annual return of the S&P 500 since 2000? Is it A, 5 to 6%, B, 6 to 7%, C, 7 to 8%, or D, more than 8%? What do you think? Again, fastest fingers first and the right answer. Very nice. Looks like we have a winner. Congratulations. The team will be in contact. Now, stay till the end because we're still giving away some prizes. So we hope that you enjoy this, and it's our way to reward you for being a part of the discussion, but at the same time, to really help you, listen and make sure that you are taking notes and you are educating yourselves about the current market outlook. Okay, so this is how you can get first access to BNY Mellon funds, all right? So if you go down to your app, if you've got it right with you right now, go to Money Plus and you click on Trade, right? So you see the trade icon on the bottom, click on Money Plus and you'll be able to see very simple fund houses, and you have the list of available funds that you can access, okay? So you see right here, for the purpose of this particular live show, we'll use BNY Mellon's funds, all right? So you click on the left-hand corner, you should see it right here. Open it up and you can see the list of funds available for this particular one. And of course, from today's session, you can take a look to see which one applies best for your overall investment strategy. But of course, really practice discretion and make sure that you make an educated, informed decision whenever you do any kind of trading or investment. So you click here, let's say you want to go into this particular fund, right? You go to fund details, you can check out the performance of the fund. I find this very, very important, especially for myself, because I do a lot of this as well. But I think the most important component for this page is really looking at the news or the analysis of that particular fund. And of course, when you click on analysis, you'll get the full details. So you got the NAV, you've got, the actual live tracking changes and also the live data that you'll need to make a decision. You've also got the news, you've got an overall perspective. You can really track every single component of this fund before you decide to subscribe. But once you decide that you want to subscribe to it, just click on subscribe on the bottom. That bright orange right there. And you can input your amount. Minimum is 100 USD for this particular one, the example that we're showing you right now. And once you're done with that, you can click on subscribe once you're ready. Okay, it's very, very straightforward, really just at your fingertips, on the go, wherever you are. But at the same time, remember, it's your personal decision, and we're just here to give you the tools, to give you the insights to help you with that. All right. Well, thank you, everyone. Now, can I just invite our guests back onto the floor, please? Okay, so I'm just going to answer a few questions, Aninda. Welcome back.
Sure, yeah.
I'm going to answer just one or two questions before we do another quiz giveaway. So the first question from the audience, someone would like to know really on the macro scale, and let's zoom in down to the perhaps interest rates and equity sectors. So investing in which sectors is considered defensive in 2023? You highlighted a lot of the analysis, but what if you were to give a top three from your perspective?
We'd still be rooting for consumer staples, utilities, perhaps even energy, and healthcare. Yep.
Okay, thank you for answering that. Since equity and interest rates have an inverse relationship, should we invest in equity if we know that interest rates will be dropping a bit? So how can I stay ahead of the curve and benefit from the reversal?
So the most crucial relationship is between real interest rates and equities. Real interest rates and the PE ratio of equities in particular. And there, we don't see real interest rates coming off until there's a material reduction in inflation. Mm-hmm. So that could be a second half of 2023, story. but not a 1H 2023 story. So which is why we're not gung-ho on, this is not the time to look for that big turning point in equities just yet. Which is why the whole premise of this of my presentation is that be defensive.
Right. Thank you for that. And yeah, of course, very important points brought up by Aninda right there. So I hope that answers your question to the audience member that asked this. But thank you. It benefited everyone. Now, Aninda, what is a sensible asset allocation in our portfolio for this environment? So how many percent of US growth stock, how many for the T-bills, etc. So I understand we cannot make any recommendations, and you guys know that too. But Aninda, maybe you could just share some insights related to asset allocation.
Yeah, so we're still, long cash, long dollar cash in particular, neutral on fixed income, underweight equities more broadly. Within equities, if you had to pick and choose, again, the defensive sectors is what I would prioritize. We've been prioritizing China as well. But more broadly, I think we're warming up to credit as part of a broader fixed income recovery story. Short duration credit in the investment grade space might be something we are re-examining at the moment. If risk-free yields continue to come off, even if there's no compression of the underlying risk spread duration, we could still be looking at more stable total return in these areas. So. But more broadly, if you look at equities versus bonds, we still dislike equities for the next 3 to 6 months at least, and prefer bonds where we are neutral, but are warming up to something more than that.
Yeah. Thank you for that, and thank you for that question. Very comprehensive. Now, Aninda, I'm going to pause you right there as we go into quiz number 2 for the giveaway. So thank you everyone for being a part of this, and we're here to reward you. So quiz number 2, are you ready? Once again, fastest fingers first, and you have to get it right. Okay, so in 3, 2, 1, what is the highest level of the 10-year bond yield since 2000? A, around 4%, B, around 5%, C, around 6%, or D, around 7%? What do you think? Wow, you guys are really, really quick. So it looks like we have a winner. Congratulations. The right answer was C, around 6% in early 2000. Congratulations. The team will be in touch. Now, Aninda, for the next question, someone wants to know about the Singapore property market. Of course, I was about to ask you myself, but someone has already asked it. Is the current investment climate appropriate to enter REITs or the Singapore REITs ETF?
That's a space I don't follow professionally.
Right.
So I'm hard pressed to provide an answer for that. I'd refrain from that, but it does seem like an energizer bunny that keeps going.
Absolutely.
Despite all the tightening we've seen so far from the MAS. But in terms of specific drivers, I'd refrain from answering that question because it's not something I look at day in and day out as part of my job.
Of course. So maybe we can rephrase this a little bit from an industry perspective. I think maybe for the short-term outlook for the first 6 months of 2023, what are your thoughts on, the relationship between, of course, the rising rates environment and the property market, not just in Singapore, but maybe the ASEAN region?
So I think things will slow down. I don't think to begin with, inflation in ASEAN more broadly, not Singapore in particular, mind you, has been much lower than it has been in the US or most other developed markets, which are more hard pressed to hike quite aggressively. So in contrast, what you're seeing in ASEAN is that the need for very steep rate hikes has not been in evidence, and central banks are getting away without going lockstep with the Fed. Necessarily. I think I keep getting asked the question, will the Indonesians have to hike as much as the Fed? My stock answer is no, they won't, because they don't have as much of an inflation problem to begin with. Now, Singaporean inflation is a bit higher. A lot of that reflects the higher rentals and so on. Wage growth has been very high as well. Labor markets are tight. So I do think that the MAS will likely hike a bit more, and that will eventually create more pressure, possibly in the real estate space as well. But there are other structural drivers, as many of you know, the immigration from Hong Kong to here and so on are factors which are also at play. So
Or
it's, sorry?
The rise of family offices as well, and that tremendous growth coming into Singapore.
Yes, indeed. So it's a tug of war, which I think is playing out. So my headline thoughts, without having specific knowledge about this, is things will soften but not necessarily collapse, given that the underlying structural drivers are intact from a demand side perspective, even though from a policy perspective, things are tightening up a little bit more than I think what many people would have thought just 3 or 6 months ago.
Right. Thank you for that. So someone would like to know, I'm using cash as an instrument. Do you think it's king? And do you agree with me that I should have this as part of my strategy right now? And part 2 of the question is, if we are in the market on a long-term strategy, should we consider going quite aggressive on the defensive right now?
So cash is definitely would have done quite well in this environment compared to any other equity returns that I highlighted in any of my charts. Having said that, it's been a long time since you actually got some yield on cash. A fixed deposit would pay you quite well these days. Short duration bonds would pay you excellently these days. So that's an area which is, I think, still worth considering. I don't think those rates will disappear anytime soon. Again, we are expecting a softening of interest rate increases, not an outright decline in interest rates. So from that, keeping that in mind, I think cash is still an important part of your portfolio. It hasn't been in years and decades, and a lot of people don't talk about it as much. But I think it's a crucial thing to maintain in your portfolio on a going forward basis still.
Thank you for sharing that. So final question that I've picked out from the audience, I think it's quite important. It's a good way to end off this live Q&A. So Aninda, you are the head of Asia Macro Investment Strategy. So someone would like to know, based on your view under the macro conditions, and you can cover Asia or beyond, of high inflation like the 70s and high probability of a recession, should we invest by industry, region, business, or all in terms of the diversification? So if I were to summarize, what is the extent of diversification do you recommend?
So we take an asset class approach, fixed income versus equities versus cash versus, within fixed income, looking at credit more specifically. So from that perspective, I'd reiterate that we are neutral fixed income, and we are warming up to taking a bit more risk in that space. If you look at investment grade credit and so on, because of the total return profile, which benefits from lower risk-free yields or stagnating risk-free yields, even if there's further stress on a spread duration basis on specific issuers and so on. But equities is something we'd wait a little bit longer. And if you want to be long in particular parts of the equity space, it's the defensive stuff which I would prioritize. Those are really cheap with this value and what's more difficult.
Just to wrap up, I know you already shared a key takeaway, but what is that driving advice, or at least key insight, you would like to leave them with before we end off?
So watch this debate play out. So the way I frame my views is very top-down macro, and I think it's a great way of framing an investment thesis, personally, because this is what I do for a living, but also because getting that macro story right is important, because it does affect a lot of things at a micro level. And yes, it is tempting to take on more risk and look for that quick, easy turnaround. And my big message is that we are reaching a peak, possibly a pivotal time for next year, but we haven't made that turnaround just yet. And there could be some bumps along the way, which is why we're still defensive. So the playbook here is to be defensive.
Aninda Mitra, Head of Asia Macro Investment Strategy from BNY Mellon Investment Management, everyone. Thank you so much, Aninda, for joining us today, and we look forward to the next show.
Thank you for having me. Good to be here.
Hope to see you soon. Now, to everyone watching, thank you again for your comprehensive questions. As usual, it's always a pleasure to have you on board the discussion because it's not a one-way conversation, it's two-way, and we always enjoy sharing the insights with you to help you make better investment decisions. Now, with that, I would like to end off with the third and last giveaway for today. Are you guys ready for the question? All right, once again, fastest fingers first. And for those who just joined, you got to get it right and make sure that you type as quick as you can. All right. So in 3, 2, 1. Got the question, yeah? So how many times has the yield curve been inverted since 2000? What do you think? Amazing. We've got all the answers come in and we've picked a winner for today. So congratulations. Our team will be in touch with the winner that they've picked out. All right. Congratulations. Thank you so much for joining us today. Okay, so if you enjoyed today's show, it's just the first of a series that we've got lined up this week for Q4 investment strategies. It's very important this year and going into the new year that you pay attention to the potential opportunities and risks that are associated with the next year and the next few months. So it's not really about the short-term horizon that we're looking at only. You know, we're looking also at potential long-term strategies that you can implement with your portfolio. And it's always about covering a wholesome picture for you guys. So we're here as the bridge, the access to our experts on site. And of course, we look forward to the next show. And the next one will actually happen in about 1 hour. So we really hope to see you there as well. I will not tell you what the topic or the speakers are because I would like you to find out for yourself. So connect and follow us by scanning this QR code. And we'll see you for the next show if you want further details on that. All right. And of course, you know, as always, we've always got these new campaigns for you. We've got the World Cup campaign as well, and some pending promotions and also new information and educational content to help you with financial literacy. So follow us on socials. We've always got our main shows up, and it's always fun to put out new content for you guys, all crafted specially for you. So just scan the QR code if you want to find out more. And of course, more details about the campaign on the World Cup right here. So do check it out because it's something quite exciting. And I really hope that it also helps you in your overall strategy going into 2023. So thank you so much for joining us for the first show. We'll see you for the next one later on today. And signing off live from Singapore. See you soon in 1 hour. Signing off, I'm Olivia Higgins. See you later.
Bye.